In this video, we are going to have a look at IFRS 16, covering the topic of leases. So firstly then, there are some definitions that you need to be aware of. So what is a lease? Well, a lease is a contract or part of a contract which conveys the right to use an asset. It will be an underlying asset and it will be used for a period of time in exchange for consideration. We then have the lessor. So this is the entity providing the right to use an underlying asset for a period of time in exchange for consideration. We then have the lessee, which is the entity obtaining the right to use an underlying asset for a period of time in exchange for consideration. So I've used the term right of use of an asset. So what do I mean by that? Well, this is simply the asset representing a lessee's right to use an underlying asset during the lease term. So, lease accounting then. So, the lessee is the entity who will use the asset on a day-to-day basis. It is that entity that will have the right to use that asset, and the lessee will make the payments to the lessor. So, a basic principle to remember here. So, upon commencement of a lease, the lessee should recognise a lease liability and a right of use for the asset. So, initial measurement then. So, you would have the lease liability. This would be initially measured at the present value of the lease payments that have not yet been paid. So lease payments should include the following: any fixed payments over the lease term, any variable lease payments dependent on an index or rate. This will be initially measured using the index rate as at the commencement date. Any amounts expected to be payable under residual value guarantees. So a residual value guarantee will be provided or should be provided by the lessee, and it will state the underlying asset at the end of the lease term will not be worth less than a specified amount. This will reduce any risks to the asset itself with damage, and it will also have an impact upon how often the entity actually uses that asset. It will include the exercise price of a purchase option if the lessee is going to be reasonably certain to do that at the end of the term. It will include any payments of penalties for terminating the lease. So if the lease term reflects the lessee exercising an option to terminate the lease. So ultimately then, to determine the present value of any lease payments that have not yet been paid, the discount rate should be the rate implicit in the lease. Sometimes an implicit rate cannot be determined. If that is the case, the rate that should be used should be based on the incremental borrowing rate. So the right of use of an asset then. So this will be initially recognised at cost, and it will comprise of the following. So the amount of the initial measurement of the lease liability, any lease payments made at or before the commencement date, any initial direct costs, and any estimated costs of removing or dismantling the underlying asset as per the conditions stated within the lease. So within any lease liability, there has to be a lease term. So essentially, this is just the amount of time that the lessee has the right to use an asset. The lease term must comprise of how many non-cancellable periods are there, how many periods covered by an option to extend the lease, if that is going to be reasonably certain to be exercised, and contrary, the number of periods covered by an option to terminate the lease, if they are reasonably certain not to be exercised. So that's initial measurement covered then for leases. But we also have subsequent measurement. So this is all about applying depreciation and any impairment charges that may exist. So the lease liability here then is going to be the carrying amount of the lease liability increased by the interest charge. So in order to record this in our financial statements, we would need to record our finance costs as a debit in our statement of profit or loss, whilst crediting the statement of financial position with the lease liability. We would then also need to record the carrying amount of the lease liability, because ultimately it is going to be reduced by any cash payments. So in order to do this, we would need to debit our lease liability and we would need to credit our cash account. So there are lease liability table examples that you can use if you are determining how to calculate these. So if lease payments are made in arrears, you would take your balance brought forward from the previous year. You would then calculate the interest on that figure and then deduct any payments made in order to get the balance carried forward to the next period. A little bit differently then, if payments are going to be made in advance. So in this situation, you would still begin with the balance brought forward, but you would deduct the payment made to get to a subtotal. Once you have that subtotal, you would then work out the interest figure, and then adding that on, that will give you your figure to be brought down to the next period. So there is a little note then in the payment section. So payment for year one is already going to be deducted as part of the balance brought forward for the start of year one. Payment was made in advance and would not be in future payments. So do just be careful that if you are making payments in advance when calculating the lease, that is always going to be zero in year one. You cannot make a future payment for a year that didn't exist. So the right of use for an asset then. So this will be measured using the cost model. It's going to be measured at initial cost minus any accumulated depreciation and any impairment losses. So depreciation for leases can be calculated as follows. If the ownership of the asset is going to transfer to the leasee at the end of the lease term, then depreciation should be charged over the asset's remaining useful life. Alternatively, it could be charged over the shorter of useful life of the lease term. So short life and low value assets then, these are dealt with a little bit differently. So if the lease is short term, less than 12 months at the date of inception, or may just be simply of a low value, a simplified treatment is allowable under IAS 16. So the leasee can choose to recognise lease payments in the statement of profit or loss on a straight line basis. No lease liability or right of use for an asset would be recognised. And low value assets are exemplified in IFRS 16. Specifically mentioned in this section are any tablets, any small personal computers, telephones, and any small items of furniture. Other than that, that is not a comprehensive list, but they are the ones specifically stated.